In today's video, I want to show you a nice way of catching a pullback using the volume profile, plus a few other good techniques in price action analysis. Before we proceed, if you are new to the channel, please check out the other free courses and playlists I have created here in the channel, so you can maximize your learning experience. Since we're going to talk about volume today, I suggest you watch the Ultimate Beginner's Guide to Volume Trading in the YouTube card. Don't forget to watch the latest Ultimate Beginner's Guide to Scalping also, which will show you the dark side of scalping that no one else will tell you. Okay, so without further ado, let's begin the analysis. I chose the Euro USD 1 hour time frame, as you can see, and we can see that we have a price vector going up and then a price vector going down. Notice that the vector down surpasses the level where the first up vector began. When we have lower lows like that, we can say that sellers are in control. That's logical because lower lows are something that only sellers will create, meaning that they are strong enough to progressively push the market down. Whenever a trader sees this, a question immediately pops to mind, which is when and where the next pullback will end. Even though this is a simple question, there's a lot that goes into answering it precisely. In fact, the goal of price action analysis is to find where the next pullback will end or where the next reversal will occur. It's a simple question with a complicated answer most of the time. There are many ways of trying to catch the pullback, but in today's video, we're going to use the volume profile. The next pullback will be subjected to the last vector down in a way, meaning that if a pullback is going to occur, it will happen inside the range of the last vector down produced by those sellers. Given that condition, we can plot a volume profile using the last vector down as an axis. In other words, we can plot the volume profile from the highest point of the last vector until its lowest point. The reason for that is that we want to know where in this last down vector we have the highest level of trading activity. That can sometimes be used as a type of support or resistance level. In this case, since we're talking about a pullback that is going to rise and land somewhere inside the range of the last vector down, the volume profile will show us a resistance level. Let's notice a few details about the volume profile. It shows a horizontal frequency histogram. Each bar of the histogram shows how frequently that price level has been traded within the range of volume profile we have chosen, which is the entire down vector. The red line is called point of control, and it shows the largest part in the histogram, even though it's not so easy to see in this example. The point of control basically means the price level that has been traded the most within the last price vector. The theory behind this is that if this price level has been traded a lot, there is some sort of barrier for price in that level, meaning some sort of resistance or support. We can see other reflections of that in the frequency histogram as a whole. Notice how the histogram bars are bigger in the upper range of the vector and smaller in the lower range. The reason for that is that we have some sort of congestion in the upper range of the price vector when price is trying to create a consolidated supply zone. In the lower range of the vector, price has already escaped and is traveling more freely without so much interruption from the buyers. So each price level is traded less frequently, hence the production of smaller bars in the volume profile. Notice that the volume profile is already agreeing with the idea of supply and demand zones. Even if we don't spend time trying to draw the upper and lower limits of the supply zone, we can safely say that the point of control is near or within the zone. So we already have two techniques converging in the same area. If we draw a pitchfork using the two initial price vectors, we can also see that the center line is pointing roughly to the same area as the point of control and the supply zone. Let's advance price a little bit to see how it develops. Here we can see that price comes back up, encounters the point of control, and produces a small bump down. It even produces a fractal bar pointing down when it meets the point of control. This is a sign that sellers are still present in this area. Price also comes back to the center line of the pitchfork. At this point, we can start thinking about a short trade since we have an area of interest. The volume profile and the pitchfork have proven themselves in a way, so now we can hopefully count on them again to enter a trade to the downside using a small logical stop loss, which is a necessity. Notice that there is a moment where the point of control intersects with the center line of the pitchfork. When we are looking for entries, we want points in time where different techniques will intersect. And this point where the point of control intersects with the center line is a good candidate. We also want to see some sort of reaction in price if it touches that point. So let's see if price indeed produces that reaction. This candle right here is the green light for a short trade given the context we have found so far. Notice how the upper shadow touches both the point of control and the center line of the pitchfork simultaneously, and it produces a bump down as we can see by the prominent upper shadow. What this is telling us is that sellers are still present in this level, and we have found a market edge. Before making the decision to trigger a trade, we need a safe and logical stop loss level. In this case, the stop loss can be above a level where sellers will represent a cushion of protection, so to speak. One example of that is the fractal bar that touches the point of control for the first time. One possible entry in this case would be triggering the trade at the open of the next bar. Ideally, we want a 1-to-3 to 1-to-4 risk-reward ratio. Notice, however, that this risk-reward ratio will fall near the last significant low, so we can try to optimize the target by placing it at the outer frequency of the last significant low, which will yield roughly 1-to-4 risk-reward ratio. So let's see how the trade develops. Notice how sellers were indeed present and were able to push price down again. Notice how price gives yet another chance of entering the trade before it starts to go down. Sometimes you have several chances to get in, sometimes you only have one, and sometimes there is no chance to get in the trade at all. Even though sellers could generate a movement down, they were not able to produce a lower low in the major flow, but in any case, this movement down is enough to produce a high quality trade with 1-to-3 to 1-to-4 risk-reward ratio. Maintaining this sort of quality of entry and risk management will make your equity curve grow consistently without psychological distress, which should be one of the major goals of any trader. That's it for this video. If you want to learn how to read the market like this and use these techniques and many others, check out the video description for my paid courses or send me an email so we can talk about the best course option for you given your level of experience. If you enjoyed the material I produce, please click the like button, subscribe to the channel, activate the notifications button, share the video, and leave your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.